Good evening, everyone. I welcome all the participants to the third quarter 2018 earnings conference call of Rain Industries Limited. Speakers on today's call are Jagan Reddy Nellore, Managing Director of Rain Industries Limited, Gerard Sweeney, President of Rain Carbonate, and T. Srinivas Rao, Chief Financial Officer of Rain Industries Limited. During the call, management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. We recommend viewing this presentation while listening to management's discussion. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature. They could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Jagan to provide an update on key developments within the Rain Group. Over to you, Jagan.
Thank you, Ryan. A very good evening to all the participants. In the third quarter of 2018, Rain achieved a consolidated revenue of Rs 34.9 billion, adjusted EBITDA of Rs 5.6 billion, and adjusted net profit after tax of 2 billion rupees. After a 12-month period wherein our raw material costs were relatively lower compared to the rising finished product prices, resulting in an increased adjusted EBITDA, we saw a return to more typical market conditions in the third quarter. Raw material costs caught up with our average sales price that had also somewhat declined, and this was one of the causes for the reduction in quarter-over-quarter adjusted EBITDA. Beyond the shrinking gap between raw material costs and average selling prices, several other factors impacted our performance during third quarter. The first was a drop in volumes after several quarters of steadily growing demand, but the quarter total volumes were down 83,000 tons, of which 117,000 metric tons was down in our carbon segment, which was marginally offset by an increase from our advanced materials and cement segments. These lower volumes played a significant role in the quarter-over-quarter decrease in the adjusted EBITDA. Another was increased logistical costs due to low water levels on a major European transportation route. While we had anticipated a reduction in third quarter volumes based on contractual shipments, the situation was further complicated by some customer outages and exacerbated by the India pet coke ban. We anticipate further impacts in fourth quarter from the resetting of prices, transportation disruptions, and the India pet coke ban. Addressing the ban, a sudden ruling by the Honorable Supreme Court of India on July 26 that prohibited the importation of pet coke forced us to radically shift production schedules and reroute raw materials and customer shipments, while simultaneously working to gain an exemption to the import ban. The ban also required us to use more of our higher cost inventory in India during the quarter, since we were unable to import the lower cost grades that we would typically blend with small amounts of the higher value Indian CPC to meet customer requirements. Jerry will provide more on this subject in the coming slides. Our third quarter earnings were also impacted by restructuring activities in Germany, where we are closing few production units that no longer meet our investment and return criteria. A $2.9 million expense was taken for associated costs incurred during the quarter, and we will expense the remaining restructuring costs during the subsequent quarters. Beginning in the second half of 2009, we expect the restructuring to yield an annual run rate savings of $4 million after considering all the effects of the restructuring. Finally, we incurred expenses of approximately $2 million during the third quarter for long-term strategic projects the company had initiated to improve the profitability of our advanced materials business and to centralize its operations. Now turning to slide 4, Jerry will take you through the industry updates on the slide of this presentation. Jerry?
Thank you, Jagan, and good evening, everyone. It's a pleasure to speak with you all again. On the chart to the left on slide 4, you can see that there has been very little growth in aluminum production compared to the prior year. This is primarily related to delayed restarts in the United States and a decline in production from China. The United States aluminum production was further impacted during the quarter by two technical disruptions that caused aluminum smelting plants to come offline. In general, the U.S. market outlook for aluminum continues to be bullish due to the tariffs that have been implemented. By contrast, in China, we have seen the opposite. The Chinese aluminum market grew by 5.5% last year, in calendar year 2017. However, in 2018, the market appears to have contracted due to a tightened supply of alumina and higher costs, especially for energy. It has become harder for the higher-cost Chinese plants to compete due to the falling SHFE pricing and the lows on the LME we have seen for the last 3 months for exported aluminum, as well as weaker Chinese economy overall. On a global basis during the last quarter, the aluminum market has been fairly turbulent due to the conflicting signals related to sanctions, labor disruptions, and plant closures, as well as reduced car sales in Europe. On the chart to the right, you can see that we have had a fairly long run of upward pricing for both crude and fuel oil. The upward trend has been beneficial for the company as we're able to maintain steady margins for the liquid products that we produce from the distillation, and they are indexed to these prices. On the negative side, we did see some weakening of the benzene quotations in the quarter. Now let's turn to slide 5 on the petcoke ban in India. On July 26th, the Honorable Supreme Court of India issued a ruling that banned imports of petcoke for use as a fuel in response to growing environmental concerns surrounding smog and air pollution. While passing this wide-sweeping ban, the court did provide exemptions for some specific industries, namely the cement, lime kiln, calcium carbide, and gasification industries. The cited reasoning for exempting these industries is that they use petcoke as a feedstock rather than a fuel. However, the exemptions did not include calciners or aluminum smelters, despite the fact that these industries also use petcoke as a feedstock. As a result, our company had to develop alternative plans for shipments of GPC and CPC that were headed to India prior to the July 26th ruling, as well as redesign our sales and supply plans for the quarters ahead. Excuse me. The shipments already bound for India received special permission to be stored at the ports once they arrived in Vizag, resulting in unplanned storage costs. The petcoke ban also resulted in unanticipated import tariffs on GPC and CPC that had been shipped to Vizag for blending prior to the court's ruling. Before July 26th, our intention was to export much of that calcine and blended material back out of the country to customers in the Middle East and elsewhere. Doing so would have allowed us to avoid expensive import tariffs since the CPC would not remain in India. Instead, since the import ban cut off our ability to resupply the Vizag plant, we had to curtail exports from India to ensure we would have the inventory of CPC required by our aluminum customers in India until the situation could be resolved. This also meant that shipments that would have been exported from India would now be coming from our calciners in the U.S., resulting in incremental costs related to storage, import tariffs, and legal fees in India, as well as some costs that will impact fourth quarter earnings. On October 9th, 2.5 months after its original ruling, the Honorable Supreme Court of India provided an exemption to calciners, allowing our industry to import up to 1.4 million metric tons of green petroleum coke per year as a feedstock in the production of calcined petroleum coke. The court also provided the aluminum industry an exemption to import up to 500,000 tons of CPC with a sulfur content of 3.5% or below, which is manageable. Absent from the ruling, however, was an exemption for CPC imports by the calcining industry. At our Vizag plant, we have imported as much as 250,000 metric tons of CPC in a particular year, coming from our U.S. plants and other global sources for blending to support the Indian aluminum industry and export markets. Total domestic Indian CPC requirements are 1.6 million metric tons per year, and the domestic aluminum market requires approximately 1.5 million metric tons of CPC per year based on current production volumes of approximately 3.4 million metric tons. It appears that the court has aligned the exemptions with current calcination and aluminum production requirements. Unfortunately, this leaves no room for the expansion of either industry. We are also approaching the Indian regulators to permit imports of CPC for blending and sale into our current Indian and export CPC customers, and GPC for our greenfield CPC plant under construction in the Special Economic Zone, or SEZ. Although the SEZ plants have certain additional privileges for importing prohibited or restricted items, RAIN will consider all options, including approaching the Supreme Court as may be necessary in order to secure the exemptions. We will keep you updated on progress as this situation evolves. With that, I'll hand the call over to Srinivas to take you through the consolidated financial performance of RAIN. Srinivas?
Thank you, Jimmy. And good evening, everyone. It is a pleasure to speak with you today. In the third quarter of 2018, RAIN achieved consolidated revenues of 34.7 billion compared to 30.4 billion in the third quarter of 2017, an increase of 4.3 billion or 14.3%. This resulted from 2.9 billion or 14.6% increase in revenue from our carbon business segment and a 1.4 billion or 17.1% increase in revenue from advanced material business segment. RAIN's consolidated adjusted EBITDA decreased by 1.1 billion or 16.7% compared to the prior year, with carbon decreasing by about 1 billion rupees and cement decreasing by about 0.1 billion rupees. While the overall performance of the business did decline year over year, given the recent headwinds and rising cost of raw materials, it is notable that our performance during the first 3 quarters of 2018 is the best for comparable periods in the company's history. The margins of our advanced material segment was weaker in the third quarter, primarily due to increasing raw material prices, the impact of U.S. tariffs on some Asian sales, and a few technical issues at customer facilities. In addition, as Jerry mentioned earlier, the slowdown in European automotive sector, which is related to car buyers' uncertainty about new environmental law, had an impact on our advanced material sales, since a majority of our products in this business segment are used by the auto industry. Now turning to the next slides on the carbon business performance. Revenue from carbon business segment was 22.8 billion for the quarter ended September 30th, 2018, compared to 19.9 billion for the same period last year, which we noted in the previous slide as an increase of 2.9 billion or 14.6%. During third quarter of 2018, the average blended realization increased by about 35.8% after considering the favorable impact from the appreciation of the US dollar and the euro against Indian rupee by 8.9% and 7.9% respectively. Sales volume of CPC and CTP, calcined petroleum coke and coal tar pitch, decreased by 21% and 14% respectively, partially offset by 1.4% increase in other carbon products. Revenue from other carbon products was primarily driven by a mix of price increases due to higher fuel oil prices and lower volumes due to European Union requirements related to the use of certain products. Overall, after the partial offset of the improved realization with lower volumes, the revenue from carbon segment increased by 14.6% in Q3 of CY18 as compared to Q3 of CY17. The decline in CPC volumes was largely due to timing of the shipments, curtailments of few customers, and delays before the calcining industry gained an exemption from the Honorable Supreme Court of India. The decrease in CTP volumes was primarily driven by the disruptions in the production at customer facilities. Turning to next slide on the performance of the advanced materials, slide number 8. Revenue from advanced material segment was 9.7 billion for the quarter ended September 30th, 2018, as compared to 8.3 billion for the same quarter in 2017, an increase of 1.4 billion rupees at 17.1%. During third quarter of 2018, sales volume in petrochemical intermediates increased by 37%, which is offset by decrease in sales volume of engineered products, naphthalene derivatives and resins by 2.9%, 9.1% and 8.1% respectively as compared to third quarter of 2017. During third quarter of 2018, the average blended realization increased by 14.5%, along with the favorable impact of the appreciation of the euro against Indian rupee by 7.9%. Due to the aforesaid reasons, the revenue from advanced material business segment increased by 17.1% during third quarter of CY18 as compared to third quarter of CY17. Moving to the slide on the cement business, slide number 9. During the third quarter of 2018, there was a mixed trend in sales volume in our cement business. There was an increase in volume in certain markets such as Andhra Pradesh, Telangana, Tamil Nadu, Karnataka and Kerala, partially offset by a decrease in volumes in Odisha, Maharashtra and Goa and Pondicherry. Overall, our cement sales realizations decreased by 5.6% during third quarter of 2018 as compared to last year, and they were partially offset by an increase in volume by about 6.1%. Due to these reasons, the revenue from cement business increased by 0.2%. However, EBITDA from cement segment decreased by 0.1 million due to increase in operating costs and lower cement clinker ratio. We are working towards reducing costs by various efforts, the largest of which was the installation of our waste heat recovery power plant at our Kannur and Nalgonda facility to enable the plants to produce approximately about 7 megawatt and 4 megawatt respectively of electricity from the waste gases generated in the manufacturing process. All the electricity generated by these units will be consumed at the plant itself. In addition to this, we have also upgraded a cooler in our Nalgonda plant at a cost of 156 million rupees to achieve energy efficiency. Further, as discussed in the previous slides, we are undertaking technology upgrade at our Kannur facility to improve the efficiency. On a positive note, we have seen increase in market demand in the states of Telangana, Andhra Pradesh, Tamil Nadu, Karnataka and Kerala as compared to the previous quarter, and we anticipate this demand continuing throughout the year due to infrastructure and housing projects. Moving to the next slide on debt, slide number 10. At the end of the third quarter of 2018, our gross debt was $1,130 million US, which includes the $62 million US of working capital debt. During the year, the company has invested over $34 million in the working capital required to run the business in current high-priced environment. Despite this increase in working capital borrowing, have only increased by about $12 million US, and the rest was funded with internal cash generation. In addition to this, the company has used about $38.7 million towards repayment of long-term debt during the refinancing that was completed in the first quarter of 2018, and spent about $120 million on capital expenditure for the 9 months period ended 30th September 2018. This capital expenditure includes expansion capital of $24.1 million for our hydrogenated hydrocarbon resin production facility under construction in Germany, and $5.3 million of investment for our vertical shaft calciner project we are building in India. The company ended the quarter with a net debt position of $1,011 million, and net leverage ratio of 2.6 times based on LTM adjusted EBITDA of with $101 million of cash on the balance sheet and unused credit limits of $144 million. The company is comfortably placed to meet its repayment obligations and continue to make required investments to meet the market demand. Finally, the finance cost has reduced to 1.1 billion rupees in the current quarter as compared to 1.5 billion in the prior year. The 23% reduction in our 0.4 billion savings is a direct result of the company's refinancing efforts, which decreased its average interest rate to 5.3% compared to approximately 7.6% during 2017. With that, I will turn the call over to the operator so that we can take your question answers. Thank you. Over to the operator.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant only. If time permits, you may come back in the queue for a follow-up question. We take the first question from the line of Vikram Karma from Fulfin. Please go ahead.
Hello. Yes, sir. Is the Q4 capex of debottlenecking Qtr2 plant on schedule? And what would be the capacity utilization in that?
Yeah, we are expecting, yes, it is on schedule, and we expect that to complete by December. And the capital expenditure for the Qtr2 debottlenecking is $10 million.
What would be capacity utilization?
85 to 90% utilization.
Okay. And sir, European facility deorganization cost to be spread over how many quarters and what would be its quantum?
The reorganization, what we are referring is $3 million is the cost that we incurred in September quarter. Maybe we will have a similar expenditure coming in the December quarter and again.
Okay.
Thank you. We'll move on to the next question. That is on the line of Sanjay Jain from Motilal Oswal Securities. Please go ahead.
Thanks for taking my question. My question is on carbon division. I mean, this performance is down sequentially, and you have given reasons because of the import ban, and like we had to utilize higher cost inventory. There's one more thing. Is it, I mean, the volumes are down, I understand that part, but average prices are also down for that segment. What will you attribute this to? Like, is it a product mix or it's got more to do with the decline in the prices?
Jerry, can you take the question from Sanjay?
Yeah. We have, thank you for your question. We experienced, we acknowledge clearly the volumes were down. To give you a little more color on that, the volumes were expected in the third quarter to be down, versus the second quarter, just from a customer demand perspective. But also volumes were impacted somewhat based on the occurrence of the ban and product moving around. Beyond that, we did see essentially what you will, and this is what Jagan was referring to in his commentary. We did see 4 quarters of very strong margins where sales prices were outstripping raw material advances. And during the third quarter, the sales prices did top out and in some instances did decline, while raw material prices did continue to advance. So there's a shared responsibility, if you will, for the fall in profitability between both the volumes and the margins related to the quarter.
Right. Could you give a sense on what kind of volume we should expect in the fourth quarter? Because you would have now good idea about how much volume we are losing because of the disruption in India, in the CPCs.
Yeah, our volumes should be stronger, but we still will be working off the inventories and dealing with the petcoke ban disturbances that have taken place.
stronger with respect to this 375 KT CPC that we have done in the September quarter. But will it be lower than the second quarter's number 474? Or like
it will be lower than the 474 because there is a ban still continuing, on the CPC that will be imported from the U.S. because calciners are not permitted to import the CPC. That means, basically we cannot import any material unless we get clarification from the Supreme Court on importing CPC. We are not permitted to import CPC as of now, so which means our volumes will be down, please.
Right, but aren't we trying to directly sell CPC to the customers where you may not have any restriction?
Yes, but we are also working with that, but that's a little more time-consuming affair because the material what normally we get is not calcinable directly. We actually bring in I would say, little higher sulfur and higher metal coke, and then we bring and blend it here. So basically, if we start selling direct material which is compliant with the aluminum smelter requirement, the cost would go up. So it would not be more profitable. So since we bring all the way and then we blend it, actually it's more, we can bring in a lower materials that actually doesn't need importation of GPC into the U.S. We actually make materials with whatever GPC that is available within the U.S. So that keeps our costs under control. So direct sales to aluminum smelters is not very remunerative for us.
I see. Then we're going to see this impact lasting for a longer period than just one quarter. Is that
no, we hope to get a clarification because there are certain rules in the DGFT and if we can bring it under advance authorization, we have certain benefits. So we do expect hopefully that in this quarter we should get a resolution on that matter.
Okay. Can I ask one more question on pitch? You mentioned...
Go ahead,
yeah. So you mentioned that there was low water level in Germany in the river, which has affected shipment, and you also talked about some customer issues because of that. The shipments got impacted. How recurring is this problem? Like, is this behind us now, or is going to impact in the December quarter as well?
So basically, the River Rhine actually, which is a lifeline for all the inland shipping in Germany, basically between us and our customers, is actually very low. So we are actually able to only ship materials, which is about, say, maybe 50% of the barge capacity because of the very low levels. Actually, certain of our customers actually cannot even take materials, but we are able to ship, which means, we are actually moving materials through trucks and other possibilities. We are trying every effort, but I cannot guide you on the rivers on the rains because when they will fall in. But hopefully, if there are rains actually in upwards, basically in Switzerland and other places, hopefully it should improve the water levels. But I cannot give you a timing on that. But it's not only us, it's impacting every large German company.
Right. Okay, so basically the cost has gone up and both volume are impacted as well as cost has gone up, right? This is what...
yeah.
Okay.
That's correct.
I have more questions. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Arvind Kothari from Niveshaay. Please go ahead.
Good evening, sir. I wanted to ask on the aluminium side, so the prices have crashed to around $1,950, and at this there are articles doing that almost 40% of the European capacity of aluminium might be cash negative. So what are our views? Are our clients facing some problems with regarding to their cash losses, and do we expect aluminium production to be impacted in the coming quarters maybe, which in effect our production as well in the European facilities?
It's a good question. Thank you. We have seen a lot more negative press related to where the LME and Shefi have been. The discussion over the amount of aluminum capacity or current production that may be underwater the greatest majority of that is in China. There's only a smattering of production that are in high-cost areas that really at the current level may be underwater. They're fairly isolated. We're not greatly concerned. We've heard no conversation. We've heard no reports to this point of really any production coming off, and certainly none of our current customers appear to be affected by this. We are watching the situation carefully, though, because this is a bit unique. The fundamentals on aluminum still remain very strong.
Right.
Production and demand estimates are still remaining strong, and we seem to be in a time-lagged area of weakness related to the reported indices, but we do not necessarily expect that to last over the medium term.
Okay. Thank you. Another question was, as Jagan sir also mentioned that, the costs are now catching up with our sales prices. Similar commentary was there in, Copper's Concall days ago, that they also expect the pitch, cost to go up in the coming quarters. So I just wanted to get a sense of whether this is something which is a phenomena of the coming 2-3 quarters, or this is something that we experience would be lasting impact, and what would be the stable margins? We've enjoyed close to 22-23% margins in our carbon segment. So what do we feel going forward should be, the margins that our company is targeting, and how do we, manage these raw material cost inflations?
While we don't provide specific guidance moving forward, I don't mind commenting on that in macro terms, industry terms. What happens with our business, in particular our carbon business, whether it's from the CPC or the coal tar pitch side, we do have a period of 1 to max usually 2 quarters of correction that happen when the finished product prices turn on us in order to work off our inventories and readjust them to current market situations. And that's pretty much what we're in now, and what we've been discussing is that the third quarter was affected by that, related to a shift in finished product prices, where we're not able to match it in the immediate with lower raw material costs. However, as far as the market is concerned for raw materials, we are seeing the raw material costs adjust downward, consistent with where we've seen the finished product prices come off as well. So we're comfortable with our ability, as we always have, to reset our costs consistent so that we can protect our margin. Now, when I say that, remember, we have, in particular in the CPC side of the business, enjoyed higher margins over the last 4 quarters due to a rapidly rising sales price. We're not expecting, consistent with our comments in the beginning of this call, we're not expecting to return to those opportunity margins, but we do think that we'll be able to protect our standard margin in the industry and adjust our raw material costs consistent with the lowering finished product prices.
Okay, great. So how do we look at the...
Mr. Kothari?
Okay, I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Tirat Muchala from Elizabeth Advisory. Please go ahead.
Hi, thanks for taking my question. So the first one is on the net working capital. So at the end of calendar year 16, we had a net working capital of $228 million, which is now up to $430 million. So, my question is just that a significant chunk of our capital is in the working capital, and I don't think we've seen commensurate, that large an increase in sales. So do we foresee the net working capital to drop and, release some cash for our operation?
$400 million will be the typical capital that we will be having in the business going forward. There could be a $30 million reduction we could see going forward. But if you see substantial increases there in the inventories, from 19 billion to we have 25, from 20 billion to 26 billion, about 6 billion rupees increases there in the inventory because of the increase in the prices as well as the exchange rates.
Yes, sir. But so my question is that in the last about 18 to 20 months, almost $200 million is incrementally stuck in inventory and receivables. So is that relatively, going to stay? Like you've guided for $400 million, but are we seeing $400 million as a...
Actually, Qtr, the one issue is that, the raw material prices and finished product prices have almost, compared to 2006, have almost increased by 60-70%. So as the value comes down, basically, the value of the net inventory capital also will start coming, the net current assets will coming down, because the inventory cost will come down. So that will actually, all the cash should be rerouted back to the operations. So it means basically to the cash flow. So once we are just hoping that once the prices do come down, that is an advantage in the business is when the prices are going up, your margins improve, but the problem is it also consumes a lot of working capital. But when margins are coming down, or basically when the prices are coming down a little bit, all the cash will come back into the system. So that is one of the good things about this business.
Okay, thank you, sir. And one more thing is about the CapEx plan for the CPC business. Is that still on track, or are we going to keep it on hold for some time?
The Vizag expansion.
No, we are actually proceeding because we have all the approvals for that, including all the environmental and all the necessary approvals. So we are actually proceeding with that. So we should be operational in Q3 2019.
Okay, so and the one last thing is about coal tar supplies for our plants. Are there any problems with that, or are supplies okay for us?
No, we are fine with no issues for raw materials.
All right. Thank you, sir.
Thank you. The next question is on the line of Aditya Bagle from Equitas Investment. Please go ahead.
Oh, yes.
Hello.
Yeah, can you hear me?
Your line is unmuted. Please go ahead.
Yeah. So I just wanted to ask you, I just joined the call a bit late. What is your plan for the German restructuring?
German restructuring. Some of the chemical...
See, we have a couple of plants, that have been, we decided to shut because they're not adding much to the margin. So basically, we have decided that we're going to shut off those units. So that will require some restructuring, which means, we have to shut off the operating facilities, and also we have to have some people restructuring also. So that is actually some additional costs that we actually indicated.
Okay. How long will the facilities be shut?
Actually, we are just closing them down permanently. So, but actually, it's going to be a value accretive starting Q2 2019. So basically, it will be more beneficial for us. So that is the reason why we are shutting off.
Okay. And we expect our volumes to come back to normal levels from, I would say, 450,000 plus in CPC from Q1 onwards. Is that a reasonable expectation?
We do expect, but not this Q4 because while we expect things to improve, but I don't think you were there in earlier calls, but yes, we do think, maybe from Q1 onwards, but at this point of time, it's hard to predict, but we still have to get some clarification from the Supreme Court, and hopefully once we have that, then, we should start improving on the volumes.
Okay. And our CapEx projects, are they on track or any further delays? Like, when is the Visakhapatnam CapEx coming on stream?
We already responded back. It will be in third quarter of 2019, there will be a few months of delay, 2 months or 3 months of delay.
Okay. 2 to 3 months of delay, you're saying. Okay. And any further, any plans about our debt to bring it down a bit, anything on that front?
No, I think what are 3 expansion projects we announced in the carbon and advanced materials, they are the only 3 projects now.
No, our debt, you expect it to be at the same levels or?
Yeah, we don't expect to make any further borrowings.
Okay, fine. Okay, that's it from my side.
Thank you. The next question is on the line of Vaibhav Chaudhary from India Capital. Please go ahead.
Hello.
Yeah, go ahead, please.
Sir, we had capex plans of around 140 million. So how much is spent and how much is left to be spent?
We have spent around $30 million till now. Balance $100 million will be spending till mid of 2019, like till June.
Next year, basically, we will be spending next year.
Next year, full amount will be spent?
Yes.
Okay. And sir, second question is regarding the European facilities. Which facilities have been closed?
A few plants, 2 plants in advanced material segment is what we are planning to shut down them. Partly in Q3 and some of them will be closed in Q4 of 2018.
Okay. And sir, the reorganization cost for how many quarters is it going to continue?
This will be there in the third, first, this Q3 as well as Q4 similar amounts we are expecting.
So, is it going to continue further in FY20 also, or is it going to end?
Hopefully not. Hopefully not. Basically, we are hoping that, we may take an impact either in Q4 or Q1, but after that, there should not be any impact on the restructuring.
So,
this will also result in reduction of employees and certain severance pays, etc. we need to incur.
Okay. So, is there any quantum for that also?
Pardon me?
Is there any quantum, or can you quantify these numbers?
This quarter we already told you $3 million US, no?
Mm-hmm. Yeah. How much would be the savings then, by reducing our employees? How much can be the savings?
Annual savings of about $4 million from mid of 2019.
About $4 million. Yeah. Okay, sir.
Thank you. The next question is from the line of Pradesh Chheda from Lucky Investment Managers. Please go ahead.
So this $140 million capex, what is the capacity expansion in carbon and chemicals?
See, basically, we are expanding 40,000 tons in hydrogenation plant. That is going to cost us about $65–70 million. And then we have about $65 million of shaft calcining facility being built at Vizag in India. It's a 370,000 ton CPC plant with a 15 megawatt cogeneration plant. And then we have 10 million for debottlenecking of the distillation facilities to enable us to process petrotar.
So net capacity expansion 370,000 in CPC and some capacity addition in chemicals. That's how I put it?
Yeah, 40,000 tons in making hydrogenation resin for white water.
Okay, 40,000 tons hydrogenation. How much in chemicals? The $10 million distillation will add what capacity?
That's about 60,000 tons.
60,000 tons. And you had a 3 lakh ton capacity addition in chemicals that had come a couple of years, 1 year or a couple of years?
Yeah, that was operational in February 2016, the Russian plant.
Okay. And my last question is, if you could help us with what would be the EBITDA per ton in chemical and EBITDA per ton in carbon for Q3 and for 9 months? Ballpark number is okay.
We don't comment on future. Actually, the present information is provided in the MD&A or press release.
But I'm not asking about future. I'm asking about the Q3 which has gone by. What is the EBITDA per ton for chemical and carbon? I'm unable to locate from your presentation. And what is
here in the press release? You can see the operating profit as well as the tonnage. You can calculate.
Okay, I'll have a look from there.
Thank you. The next question is from the line of Sanjay Jain for Motilal Oswal Securities. Please go ahead.
The question is on Vizag facility. In this change situation, should we, put this project on hold and maybe once the things we get clarity on the regulatory environment and then maybe go ahead with this project?
Yeah. Sanjay, all our CPC plants are rotary kilns. This particular plant is a vertical shaft kiln. This produces a different grade of calcium petroleum coke and it is needed by the customers. So we are going ahead with the project. They know going back or stopping of the project. There could be minor delay of 2 months or so in completing the project because of this pet coke ban and special economic zone will have certain privileges to import even prohibited or restricted items. So even the Supreme Court has indicated that for expansions, they will provide additional quantities in later.
Okay, got it. And what is the pricing trend in pitch? TT pitch pricing.
Yeah, from the pitch perspective, the pricing trend has been flat to weakening, just as we've seen on the CPC side as well.
Okay. And should we say that all the cost increase, whether it is on CPC or coal tar pitch businesses, are already in, and or do you expect some more cost to increase in subsequent quarters?
Sanjay,
the inventory.
Go ahead.
Yeah, the inventory has been purchased, and we're working off those inventories. So we really, the commentary that we've provided is that we'll work off those inventories. The replacement values are in line with where we need our costs in order to protect our margin. We just need to work off those inventories.
Okay, thank you.
Thank you. The next question is from the line of Bhavesh C. from IDBI Capital. Please go ahead.
Hello, sir. After this Supreme Court fiasco that has happened, what about the customers that we were serving outside of India but in Asia? Are we still able to export CPC out of India?
Yeah, exports of CPC, there's no restriction, so we can still, provided we have capacity, there's no issue in exporting it.
But then is enough GPC available, because the quantum of GPC, CPC more or less looks like has been fixed by Supreme Court based on domestic capacities, domestic aluminum capacities. So do we have surplus, and are we servicing them? Are we servicing the countries?
See, basically the 1.4 million tons permitted is actually last year, say example in 2017, the total imports were only about 1.35 million tons of GPC into India. So basically, whatever that is there will be sufficient for meeting the requirements of all the Indian calciners that have whoever import. So if the Indian capacity, but where the issue is going to come in is, for example, in last year, Rain actually has imported about 250,000 tons of CPC. That is not permitted. So basically, we may have some issues in meeting the Indian export commitments. So what we are doing is we are trying to redirect them to our U.S. facilities to meet our export commitments. So we still should be able to match that. So once we do that, then it should be fine.
Okay. And my second question is on Chinese aluminum production. Now, in this year to date, we have not seen any growth in the production in aluminum. So whatever CPC capacities are available in China, are those directing towards exports, and are we seeing surplus in CPC, and hence margins are likely to be subdued?
The prices, we have seen more volumes this year, and we reported the same thing during the second quarter, that we've seen more volumes of Chinese coke available for export, and that's consistent with the lower aluminum production numbers that we've seen. We don't see them dumping product on the market as we have in the 2012 to 2016 period as far as the CPC prices. They are, though, responsible for the the volumes they have been exporting, are responsible for the pricing weakness that we've seen, in particular in India as well. We have seen those prices, however, firm up, so we're not too terribly concerned about continued drop in CPC prices out of China, supported by strong GPC costs on them as well. So they were responsible really for the price drops that we've seen, but we're not seeing that trend continue.
Okay, sir. Thank you.
Thank you.
Thank you.
The next question is from the line of Mithul K. from ICICI Prudential. Please go ahead.
Good evening. Just one question on the inventory part you talked about in a couple of questions before. Just to understand how long will it take for this inventory adjustment to happen? Will it happen within the quarter 3 results, quarter 4 results itself, or it will go on for more than one quarter? And second, on this adjustments that we will go through, how brutal it would be on for the margin for one particular quarter? Because if I recollect it right, it has happened in the past also where one quarter would just disappear in terms of profit. It will go to zero because there was a sharp movement in the prices and it took one quarter to for the margins to go. So are we seeing such kind of a situation, or it will be something similar in terms of margins that we saw in quarter 3?
See, normally the inventory normally the inventory just gets adjusted over a period of time, basically depending on how the prices move. When the prices are going up, actually you will see that the CPC prices go up first and then GPC prices slowly follow. And when they're coming down, the same thing happens is basically the CPC prices come down first and then GPC prices slowly follow. But it takes time to, to stabilize. Once they stabilize, then you will actually see the benefits of the inventory reductions. So basically, which means, it could take anywhere 6 to 9 months for the inventory reductions to actually happen. On the second question, Jerry?
Yeah, we're as far as margins, I understand what you're talking about. We're coming off such a nice high base. We're not going to see any kind of huge impact. You referenced zero. We've never fallen to really zero, but we have had, going back to first quarter of 16, we had a very low earnings quarter, if that's what you're referencing, where we came off of a high inventory position where prices dropped precipitously. That's not the instance here. Even though we have a high base, we've not come off remarkably in our finished product sales prices. So we're not looking at anything like that. However, if you are looking at our last 4 quarters, you can see that we're coming off. And to reiterate what Jagan's saying is we'll work through this in the 3rd and 4th quarter, clean out that more expensive inventory and be refreshed for the new year.
Okay. That's good to hear. And secondly, in terms of, I missed the initial part of the commentary. So just in terms of overall industry capacity, are we seeing an overcapacity or it seems to be more or less balanced again? And if I may be allowed one more question, what would be our plans from a 3 to 4 year perspective? Where do we see in terms of capex, capacity additions, and or balance sheet deleveraging? How would the management would like to see the company 3 or 4 years down the line?
Yeah, I mean, to deal with the first part of your question, from a capacity utilization or oversupply situation, we're not seeing a rapid change. From a CPC perspective, as I commented earlier on the question, we are seeing more availability out of China. So we'll be watching that. If China continues to cut aluminum production, exports from China could become an issue again. However, remember that there's a lot of more instantaneous issues that we believe are creating some of the results that we're seeing, the sanctions, the tariffs and such that are disrupting normal trade routes. We think that the industry will ultimately digest that and move past it. So we're not too concerned. We remain, and now addressing the second part of your question, we remain very much committed to the future demand of the aluminum industry and looking out 4 years, there's still very strong expectation that in today's, cleaner, greener, lighter, faster world, aluminum will remain the light metal of choice. And as long as that outlook remains, that macro trend remains, we want to maintain our leadership position in supplying the industry, the aluminum industry, with their carbon needs. And that's the reasoning behind the growth CapEx that you're seeing, the aggressive growth of CapEx plans that we have in place. The immediate things that are happening in the marketplace, we'll continue to monitor, but there's nothing there that is fundamentally over the long term saying that less aluminum demand and less aluminum production will be out there in the world for us to feed, and we want to maintain our position in doing that.
Thank you. The next question is from the line of Gunjan Kabra from Nivshay. Please go ahead.
Sir, I wanted to know that there's a fall in CPC prices, and what is the reason for that, and how much production will be hampered due to blending facility not operating in the India plant also and in the US plant also. So how much production will be impacted because of this?
Basically, we think, basically we have not been operating from July 26th to 27th onwards, basically 2 kilns, that were dedicated for India. We have not been operating our 1.5 kiln, you can say that. So I would say if they are not operating, maybe 100,000 tons. Between the second half, we'd say 100,000 tons is impacted.
Okay. And so what is the reason for the fall in revenue, fall in the prices of CPC?
It's the market-determined prices, actually. So they have been increasing for the last 2 years or so, and now they started moderating.
Okay. And so in the engineered production, like the prices, we have seen the prices of CPP has increased quarter on quarter. So what is the reason for the price decline in the engineered product division? Because it is carbos and petros, which is also a variant of CPP and which is highly priced in CPC. So what is the reason for price decrease in that?
There's no major decline in the prices of carburetors. It could be change in the product mix, because when we sell to different customer industries, different prices will be charged. But overall, there's no major decline in the prices of carburetors.
Okay.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Jagan for his closing remarks.
Thank you. Many influences and changes that are taking shape in the global marketplace have affected our recent performance. However, we have every confidence that in the medium run, we are well placed. Medium run, we are well placed to compete effectively and drive the future of our industry. Long-term aluminum demand remains bullish in today's lighter, greener, and faster world. Our new product pipeline remains robust, and our global operations are positioned to fill the needs of industry going forward. We will continue to manage our businesses and balance sheet aggressively, monitoring the markets to adapt quickly in order to capture opportunities. Thank you for joining the call today. We look forward to speaking with you next quarter. Thank you.
Thank you.